Welcome back, everybody. Today we're talking about Crocs. You know those ugly rubber or plastic or whatever they're made of things that I thought would never last but are now a $5 billion business doing partnerships with the likes of Justin Bieber, Post Malone, and Bad Bunny. And if you don't know who those people are that I just mentioned, go ask your kids. They'll definitely know, and they'll probably be wearing their Crocs when they do so. Over the past 5 years, Crocs has outpaced the return of the S&P 500 by 4.5 times. They've had double-digit organic growth, as well as an acquisition of the Hey Dude brand in 2022. Plus, they have profit margins that outpace larger, more established rivals like Nike and Lululemon. So is Crocs a buy right now? Let's find out. So before we dive into the business, let's take a look at some basics. All right, if we jump into Seeking Alpha, we see that Crocs is currently trading at a price of $87.99. Over the past 12 months, Crocs is up over 13%, but if we look year to date, it's actually down over 17%. In terms of dividend yield, Crocs doesn't have one because it doesn't pay a dividend. So you might be saying, wait a minute, I thought your portfolio strategy was dividend growth, and it is, but that doesn't mean that we shouldn't be looking at companies just because they don't pay a dividend. I think there's still value in understanding what other companies look like and trying to find opportunities where they make sense. Plus, when I started digging into Crocs, there's a good lesson in here that I wanted to share with you guys, and we'll get to that at the end. So if we look at the momentum tab just to see how Crocs has performed against the S&P 500, we see that over the past year, it's underperformed a little bit, but then over the past 5, it's up about 4.5 times. And if we just look at 10 real quick, we can see that it's up a little bit more than 2x. And Crocs was a company that I didn't really have on my radar. It actually came up when I was doing my Nike analysis as a niche competitor, and I decided to dig into it and add it to the stock analysis library, which continues to build. So if you want more analysis and are interested in getting access, check the link in the description. All right, so we have an idea of what the stock is doing and how it's performed. Now let's dig into their business. Crocs is a lifestyle footwear and accessories brand that sells its products in about 85 countries through wholesalers, retail stores, e-commerce sites, and third-party marketplaces. Crocs has about 340 company-operated stores around the world. So how does Crocs actually make money? Well, their revenues are broken down into the following categories. There's Crocs brand, which accounted for $2.66 billion in 2022, about 75% of the revenues. And then Hey Dude brand, which accounted for $896 million in 2022, about 25%. And Hey Dude was actually acquired by Crocs in February of 2022, so that amount may be partial or prorated. Now, if we take a look at their revenue growth, we see that Crocs is showing a revenue growth of just under 37%. But that actually has a lot to do with the Hey Dude acquisition in 2022, so it's a little bit skewed. But even ignoring the Hey Dude acquisition, organic growth for Crocs brand from 2021 to 2022 was 15%. And for the most recent quarter, June 2023, year-over-year growth for Crocs brand was 14%. Now, when you include Hey Dude, revenue growth is only up 11% year over year as they've had some slowing demand from wholesalers. And while overall growth has been good, growth internationally, especially in Asia, has been even better. Asia revenues grew 39% in the most recent quarter, with China revenues increasing over 100% ahead of their expectations. The Crocs management team sees Asia as a long-term growth driver for the brand. Now, when we look at the breakdown of sales channels by product segment, we see it breaks down like this. Wholesale accounts for about 55% of their total revenues. Crocs brand bringing in $1.38 billion in 2022, and Hey Dude brand bringing in $574 million, which means that direct-to-consumer currently makes up about 45% of their revenues. Crocs brand bringing in $1.28 billion in that channel, and Hey Dude bringing in $321 million. And when we look at the growth of the sales channels, it looks very positive, with direct-to-consumer on Crocs brand up 12.5% from 2021 to 2022, but up 25% in June 2023 on a year-over-year basis. Hey Dude direct-to-consumer is up 30% in that same time as well. And if we take a quick look at free cash flow, Crocs free cash flow growth has been solid, even taking into account the Hey Dude acquisition. Free cash flow was up over 2 times year over year with the most recent quarter and up 27% on the trailing 12 months versus the previous 12-month period. And with that in mind, let's take a look at Crocs profitability. Now, Crocs margins are very good across the board in relation to their sector medians as well as their own 5-year averages. Gross margin is at 53.33%, the sector median's only at 35.41%, and their 5-year average is a little bit over 44%. Now, if we look at net income margin, it's at 17.21%, and free cash flow margin is 15.60%. And both of those are well above the sector medians, as well as better than Crocs' 5-year average. So overall profitability seems to be a strength, even with gross margin being a little bit down. The way that they've been able to grow free cash flow margin and net income margin has been very good. And add that to the fact that direct-to-consumer sales are growing at double-digit rates, and that really bodes well for their margins going forward, even if they've had some issues with wholesalers and Amazon gray market sales, which we'll talk about here in a minute. So real quick, let's talk about Crocs' debt situation. Crocs has about $2.3 billion in debt versus only $166 million in cash and short-term investments. Their interest coverage ratio is also relatively low at about 5.91, and what that means is that they're heavily dependent on the cash flow that they're generating to be able to manage their overall debt position. Currently, free cash flow growth looks very good, and they've been aggressively paying down their debt with the excess cash flow since the Hey Dude acquisition in early 2022. But they're going to have to keep generating that cash flow to be able to get that debt position down. So to me, this seems like their biggest operational risk. And that's a good segue to start talking about the risks that we see in Crocs' business. And we'll put that one at the top. So one, a slowdown in cash flow generation could impact their ability to pay off their debt. So like we touched on, the acquisition of Hey Dude added about $2 billion of debt to their balance sheet. And it was part of the reason that S&P Global actually downgraded Crocs and their outlook to negative in 2022. Now, in early 2023, S&P Global updated it to stable, but Crocs currently only has that $166 million in cash and short-term investments, which, again, means that they're heavily dependent on that cash flow to be able to service their debt. And I'm just calling this out as an issue. It's not that their revenues aren't growing, because they are. It's not that free cash flow isn't growing, because it is. But they're going to have to maintain that while they aggressively pay down debt to be able to get it to a more manageable position. And what that means is that any reduction in demand or other factors could have an outsized impact on their ability to manage their debt position. Which brings me to risk number 2. A decrease in popularity could severely impact their business outlook. Now, Crocs customers are known to be a passionate and loyal group, but niche fashion trends can die out quickly. Crocs has done a good job innovating around their product, though, as the introduction of gibbets, which are personalized charms that you attach to your Crocs, increase customer attachment to the product, increases recurring revenue, and adds an additional revenue source to their core product. And the way that I look at this is, gibbets are kind of like the new charm bracelet that you wear on your feet, which sounds weird, but it's kind of genius because there's always new combinations, there's always new gibbets coming out, and it's a way that people can express their individuality and customize their Crocs to where they have a pair that nobody else has. Plus, their comfortable and casual shoes for all mantra resonates well with a broad group of people, and their NPS, which is Net Promoter Score, are highest with the youngest and oldest demographics. Still, Crocs will need to keep innovating their product to maintain this over the long term, since preferences and fashion get stale, and that can happen very quickly. And risk number 3, strong competitors and imitators could severely impact their business outlook. So in addition to just general fashion trends, Crocs is in a tough business where they have to compete on 2 different fronts. So one, they have to compete with established global brands like Nike and Adidas who have the money and scale to disrupt pretty much any niche trends or competitors that they feel like are impacting their business. And then second, Crocs has to deal with multiple imitators who try to create products similar to their iconic clogs design. And in some cases, both of these are combined, with companies like Adidas creating a shell-toe Adidas clog that kind of looks like a Croc. But for the first segment, Crocs has done a good job partnering with extremely popular endorsers that are popular with their core demographic to keep their brand image up. Collaborations with celebrities like Justin Bieber, Bad Bunny, and Post Malone have consistently sold out and even become high-priced items on secondary markets. And for the second risk, Crocs has tried to secure intellectual property like design patents, utility patents, and trademarks to help them deal with imitation brands. Now, I'm not sure how effective that strategy is long-term or how well that works, but at least it identifies that they know that this is a risk to their business and they're trying to do something about it. And then lastly, Crocs has seen quite a bit of gray market selling on Amazon that impacts pricing, brand reputation, and relationships with distributors. But it's something they've recognized and have actively been working to improve and get a handle on. Okay, so we have a decent idea of what's going on with their business. Let's take a look at Crocs' valuation. And if we just look at their overview with the data that was pulled in, we see their price to free cash flow and cash flow yield look really attractive. Obviously, they don't pay dividends, so none of that is there. But their dilution trend is down. Their moat is narrow, according to Morningstar. And yes, they have outperformed the S&P 500. But let's take a look at the discounted cash flows. So after adding our cash from operations, our CapEx, and our stock-based comp, we get a fair value price per share at $193.37. Now, this is quite above the current price of about $87.99. And so anytime that I see this, I want to make sure that I really feel good about the assumptions I made, just so that I didn't do something weird. In terms of starting cash flow, I basically used the trailing 12 months. Now, there has been some variability in their numbers, especially since the Hey Dude acquisition, but it's been steadily growing. So I feel like taking the most recent trailing 12 months is the right approach. Now, when it comes to starting growth rate, I'm using 10%. The calculated growth rate is 77%, and I'm never going to use a number that high when it comes to this type of calculation. And so if we go back to Seeking Alpha and we look at their growth tab, what we can see is that their operational cash flow growth, again, year over year, has been 107%. So I'm, again, not going to use a number that high. Their projected operating cash flow growth is 18. And again, that seems high. So, whenever I get into this situation where you have a growth company, especially one that's had an acquisition, so the numbers are a little bit skewed, I just try to do a conservative type of growth rate so that I don't get too crazy with it. So when you see the 10% on the sheet, there's not necessarily a ton of science behind it other than I think 10% is a healthy growth rate, especially for a company that has shown pretty consistent growth without putting in some crazy number that I don't think is sustainable. Then our terminal growth rate is 2.5%. Our required rate of return, again, is still 12%. And even being a little bit conservative with the growth rate, which I think I was, the fair value price per share based on the cash flows is well above the current price. So let's take a look at the multiples models and see if they tell us something different. So in the multiples models, I'm using these peers: Skechers, Nike, Lululemon, and Deckers. And in comparing to those companies, I get a fair value price per share of $334.66. Now, I would not take this number as gospel and go buy a bunch of Crocs and YOLO into it. But I think what it shows is that other shoe companies are trading for a much higher valuation than Crocs is. And I think part of what our job is to figure out why that might be. But let's take a look at price to earnings and see if it says something different. So when we look at the price to earnings multiples model with the same peers, we see that it gives us a fair value price per share of $298.28. So again, this is pretty close to the previous one, and I think it really speaks to the fact that these other companies are trading at much higher multiples than Crocs is. So just to get one more perspective, let's take a look at Crocs' historical price metrics and see how those are trading. So even when it comes to their price metrics, Crocs seems to be trading at an undervalued price. So when I look at this, even though these have been down for the past, year and a half, if I just look at the numbers, right? Crocs is a mid-cap growth company, and they're trading for a valuation that is a price to earnings under 9, a price to cash flow under 7. Those are pretty low. I mean, those are pretty decent price metrics for a value company, let alone a mid-cap growth company. So anytime that I get into a situation like this, where the valuation methods are super high and the price to cash flow, price to earnings are really low for a company that is growing, then it just makes me wonder what's wrong with them. So in my opinion, the biggest potential red flags for Crocs are, one, the high amount of debt that they took on in the Hey Dude acquisition, and the fact that they don't have a lot of cash and short-term investments to cover. And then two, the fact that niche fashion trends are very unpredictable, and when they go down, they tend to go down very quickly. And then you add the issue of the discounters on Amazon with imitation providers and styles popping up. And to me, those seem like the three major issues that could be pushing the price down. But as always, do your own due diligence. Okay, let's talk about overall thoughts and grade Crocs on the three criteria I use to evaluate stocks: business, operational performance, and valuation. So when it comes to business, Crocs has revenue growth that's over 20%. And if you just take organic growth, it's over 10 to 15%. They have customer loyalty, they have some intellectual property, but they're in a very unpredictable industry. Still, based on the fundamentals and their popularity right now, I would put their business as good. In terms of operational performance, they are seeing good free cash flow growth and they have relatively strong margins, but their debt position is too high, and to me that presents a significant risk. So their operational performance I would rate as okay. Now, in terms of valuation, the DCF model is over 2 times their current price, and their price to earnings and price to cash flow metrics are both under 10. So for me, valuation definitely looks good. So is Crocs a buy now? So I have Crocs as a buy, but it depends on what type of investor you are. because Crocs is a mid-cap growth company with a beta of 1.66. And what that means is that there's going to be a lot of volatility and wide swings in their price compared to the broader market. Now, for example, when I first evaluated Crocs for the stock analysis library, it was trading at $93.37. And over the past week, it's dipped almost 8%. So if you're someone who's looking for a consistent dividend payer that's going to just consistently grow slowly and not have wide price swings, this is not for you. But if you're looking for growth opportunities, I think Crocs is an interesting company, because rarely do you see growth companies with good margins trade for such low price metrics. But like I mentioned before, anytime that I see that type of thing, I just tend to get cautious, because if it looks too good to be true, it probably is. And this brings me to the lesson that I wanted to share with you guys. No stock is ever perfect. There's always trade-offs. And here's what I mean. A stock like Visa has an amazing business, an amazing operational performance, but because of that, it usually trades for a premium in terms of valuation. Rarely will you find it cheap, so you have to ask yourself, are you willing to pay a premium or not? And then when you look at a company like Starbucks, they have a really strong business, but they're going through some operational issues. So you have to ask yourself, do you believe in them turning it around, and are you willing to take that risk or not? And so with Crocs, it's a similar story. The growth metrics look good. Even without accounting for the Hey Dude acquisition, it's still a double-digit growth company. Operational performance is okay, except for the high amount of debt, which they're aggressively paying down. And they also have a lot of competition as it relates to huge competitors and imitators. And lastly, their niche fashion trend, which history shows can go away very quickly. And to me, that's probably why it's trading where it is. And so the question you have to ask yourself is, are you worried about those things, or do you think they're things that the business can overcome? Because if you do, then the fundamentals are going to look very attractive to you. Now, I don't currently own Crocs, and I don't have any plans to add it to my portfolio. My strategy in general is about dividend growth, but that doesn't mean that I'll never add a growth company that doesn't pay a dividend. But for Crocs specifically, it's in an industry that I just don't feel too comfortable about. Like, I don't want to have to worry about niche fashion trends, because what I'm trying to do is build a portfolio of companies that I can hold for a very long time and grow as they grow. But for a growth-minded investor who's not concerned with their industry or their business outlook, then I would definitely rate Crocs a buy, as long as you understand and are willing to take the risks of what it means to invest in a mid-cap growth company in the fashion industry. But that's just my thoughts on it. What do you guys think about Crocs? Are you buying? Are you interested now more after this video? Let me know down in the comments. Hope you guys have a great day out there. Financial independence is true freedom, so keep building and stacking wins, and I'll see you guys in the next one. Peace.